The founder of a trust is generally a brokerage, which puts up the capital to create the trust and forms the securities portfolio, which is later transferred to an authorized entity, such as a bank. Then the company issues redeemable trust certificates, which grant the owners the right of ownership of the securities held by the authorized entity proportional to the number of shares purchased by the shareholder. The collection of securities acquired during the creation of the company changes only in rare cases. As there is no regular management of the investment trust, the founder's annual commission is not large. It is approximately 15% of the annual net asset value. The majority of investment trusts own securities with a fixed yield, and they close when the securities reach maturity. The lifespan of trusts varies from 6 months for trusts that handle money markets to 20 years for companies working with bonds. Trusts typically specialize in certain types of securities. Some of them deal only with bonds issued by the federal governments, other deals only with bonds issued by corporations, and a third group deal only with municipal bonds. Founders of trusts earn a fee for their efforts and the risk they take by overstating the sales price of stocks relative to the price of the assets acquired at the time of the company's foundation. Investors, once they have purchased the shares, are not obligated to keep their shares in the trust for the duration of its existence. They can sell their shares to the trust at a price equal to the net asset value, which is calculated using the price of the buyer of the shares. These shares are then available for purchase by other investors.